Hi, my name is Josh.
Hi, I'm Sydney.
I'm Jackson.
I'm Jake.
I'm Neil.
We're Tamid at Vanderbilt, and this is Checkpoint Software. So to go through an executive summary for why we like Checkpoint and recommend it as a buy, first, they have strong recurring revenue engine. Their industry-leading margins with a debt-free balance sheet. Their management is very solid and disciplined with their capital, and their shares trade at a discount to peers. Finally, they are clear catalysts ahead with Infinity platform expansion, AI integration, and improved revenue mix. So to give an overview of the company, Checkpoint Software is with cybersecurity, cloud, and endpoint. What they do is they provide best-in-class protection across network, the cloud, endpoint, and workforce, and it's all unified in the Infinity platform. The CEO, Nadav Zafrir, who founded it in 1993 in Israel, and Checkpoint has pioneered the modern firewall and has evolved into a global cybersecurity leader, serving over 100,000 customers, including major enterprises and governments.
So Checkpoint has three main sources of revenue, starting with their revenue from products and licenses. They're lowest year over year with 11 million. And secondly, they have security subscriptions, which is their highest with a growth of 123 million year over year. And then lastly, they have software updates and maintenance, which is a recurring renewal service, which is growing 17 million year over year. And the takeaway from these growths is that the subscription expansion is improving visibility, margins, and mixed quality over the different revenue sources. And you can see that since the pandemic around here, their growth has been pretty high. And yeah, and industry trends for cybersecurity in general are that there's big growth in CAGR of 14%, and the industry is defined by rapid adoption of AI and cloud services, as it's very well known and seen in the news very often. And the industry demand is durable, defensive, and certainly accelerating. And next slide. And if you look at some of the other competitors doing a competitive analysis, you can see that Checkpoint is sort of the hybrid between these two different areas of cloud native security providers such as CrowdStrike and Zscaler, and then large platform leaders such as Palo Alto Networks and Fortinet. And they sort of combine all these aspects to give a wider array of services.
Okay, now we'll talk a little bit more about the risks. And first, from the competition from cloud native players, the risk is their faster growth with Zscaler and CrowdStrike. But to prevent this, we have the Infinity platform, which unifies cloud, network, and endpoint, which appeals to the hybrid enterprise buyers. Next is the legacy perception, which is that the market still sees Checkpoint as a firewall-only company, but subscriptions are growing double digits, and the platform shift is underway. And lastly, we have the margin versus investment trade-off, which is the risk is increased R&D, which leads to temporarily lower margins, but with the 87% gross margin, minimal capital expenditure, and strong FCF reinvestment, they're working to prevent this. Okay, so the investment thesis. Checkpoint Software is undergoing a meaningful transformation from a legacy firewall provider to a modern AI-powered cloud security platform. Its recurring revenue growth, industry-leading margins, and exceptional cash generation make it one of the most durable businesses in cybersecurity. Checkpoint trades at a material valuation discount to peers, creating an attractive opportunity for long-term investors as fundamentals continue to improve and the market re-rates the business. Okay, next we'll talk about catalysts. First is the AI-driven platform expansion. Next is the shift to recurring revenue mix. And then we have the cloud and SASE momentum. And finally, the improved billings and RPO.
So to speak on the DCS, we looked at our past 4 years from 2022 to 2025, our current quarter and current annuum, and we projected out from 2026 to 2030, and I'll dive into more of our unlevered free cash flow, takeaways next slide. And here we can see that we walked away with the PV of enterprise value of 30,000. We're talking in millions, so 30,000 million. And you walk down to your terminal value, and you see that your 2030 EBITDA, which we're projecting on, is 1,609. And we find our terminal value percent of EV is 83.8%. And we find that our implied perpetuity growth, walking all those down, is almost 1% at 0.9%. You drive that up to your top line here, which is our current share price as of November 18, 2025, so $190.20. And we can walk that down with a lot of assumptions like our equity beta, return on debt, and our market value debt and market value of equity, which is standard across the industry depending on your time frame. We can find that our WACC comes out to 5.93%, and our big takeaway from this is Checkpoint is undervalued at a discount of 30%, 30.65%.
So now looking at our public comps, we compared Checkpoint to some comparable companies in the industry, and what we found was that some of our multiples, like our EV/EBITDA and PE ratio for the peer group, are consistently higher than Checkpoint. So this indicates that Checkpoint is undervalued relative to its peers. And lastly, some final takeaways for Checkpoint is that it's transforming from a legacy firewall vendor to more of an AI-driven cybersecurity platform, has some stable recurring revenue, strong cash generation and margins, and a debt-free balance sheet, which is pretty unique in this volatile industry, as well as it is undervalued and trades lower than its peers, and there's some strong catalysts like its Infinity platform, AI integration, and ongoing buybacks that position it well. So overall, there's really a compelling combination of quality, durability, and undervaluation that well position Checkpoint. Thank you.